Okay, so let's do our Sahali snacks example. This is a kind of real-worldy example that I did with some friends several years ago. I have, as usual, simplified the numbers for us a bit, but other than that, it's pretty much a real-world deal. All right, so what is Sahali Snacks? Sahali Snacks is a company that designs and makes upscale nut-based snack products. And it was co-founded by Josh Schroeder in 2003. He was a Columbia University MBA. I got my MBA with Josh, and he was very successful with this company. It was purchased by Smuckers in 2017. And now I've got to go off on a slight tangent involving Josh and me and this company. So Josh was a journalist and went to get his MBA because he wanted to become a serial entrepreneur. So that's great. So he got his MBA and he started companies, and he would ask me what I felt about these companies. And so he started 2 or 3 that failed before he started Sahali Snacks. And when we got to Sahali Snacks and he was asking me about it, I said, Josh, this is really, really a dumb idea, right? What you want to do is you want to start a company that's going to have very high fixed cost relative to variable costs, something on the order of Microsoft or Facebook or something like that, where once you meet your fixed costs, all the rest of the revenue that you get drops straight to the tax line. That's how Bill Gates became so wealthy, et cetera, et cetera. And that's the model you want to shoot for. And that's the model that venture capitalists are looking for. And furthermore, you really don't want to do something in the food industry, because one bad batch of pecans and your reputation could be ruined. The brand name could be forever tainted, and it's a horrible idea. The more you expand, the more ovens you need, the more chefs you need, the more trucks you need for distribution. Just bad idea all around. Don't do it. So of course, Josh did not take my advice. And of course, this was the first company that he started that did become successful, not very successful, in fact, to be bought out by the Smuckers company. All right, enough of that tangent. Let's go back into it here. All right, so we were looking at Sahali with some issues for the CFO several years before it was bought by Smucker. And I'll give you more about that as we go along. But we've got some ratio analysis to start out. So this here is the most recent year, and this is the prior year. And you can see sales are growing by about 10%, and the profit margin's around 7 to 8%. That's reasonable for this type of company. And it's essentially an industrial company, right, with a lot of COGS and et cetera. So they're not very levered. And their current ratio, they're just getting there. And their fixed coverage ratio is looking quite good. And I'm going to need the glasses on for this. Okay, there we go. And we've got everything else looking reasonable. So key takeaways from this ratio analysis: the sales growth has been at about 10% for the past several years. That's been on purpose. When you have a company like this, you don't want to grow it too fast, because you do need those new ovens. You do need to source new supplies to get more pecans, to get more of your nuts, et cetera, et cetera. So you want to be careful about growth with this type of company. And the ratio analysis has been stable for the past couple of years. So here are financial statements in the latest year. Sales about 100 million, that very high COGS. They are an industrial type of company with a lot of baking equipment, a lot of packaging equipment, a lot of trucking equipment at warehouses, et cetera, et cetera. So we work our way through, and they have net income of almost 8 million on sales of 100 million. And then for their balance sheet, there's really nothing funny going on. Very, very simple company. They have, of course, inventory. Those are the products in process and completed that they haven't sold yet, measured at cost. They have a bunch of PPE. They have what you'd expect for liabilities, accounts payable, and they have some debt, and et cetera, et cetera. And their equity has been growing, which, of course, is a good thing. And let's look at their roll forward equations. Remember, we said we're going to have to project these two roll forward equations, the PPE roll forward equation and the equity roll forward equation. So let's see how these look. So the first thing to note here is this is my roll forward equation. I've just written it for us vertically here instead of horizontally. Equity beginning of period plus net income minus dividends plus paid in capital equals equity end of period. All right. And so here's what we've got for the latest year. Equity beginning of period is always the prior year's ending equity, right? And then here's their net income, which we just saw, 7.74. They have not been paying a dividend. We'll get to that more soon. And they actually bought back some shares here. That's why paid in capital is negative. And so their equity end of period was 80. All right, so let's look at their PPE roll forward equation. Same thing. I've got the roll forward equation here just written for us vertically instead of horizontally, right? So PPE beginning of period minus depreciation minus wear of the PPE plus CapEx plus additions to PPE is equal to PPE end of period. So they started out the year with about 91 million in PPE. And you can see that it's got their PPE has about a 10-year average life. About 10% of that PPE disappeared through wear, and they're growing, they're adding to their PPE more quickly than that. And that makes sense because they're a growing company. So they have to have more expenditure on PPE than the amount of wear they're getting on their PPE. And they ended up with about 100. Okay. And so what's happened at this point is there are a bunch of investors for Sahali, and some of them have been in since the very beginning, and it's not a publicly traded company at this point, and they're looking to get some money out of the company. So they'd like to get some dividends. So Sahali's never issued dividends, and the board is saying to the CFO at this point that going forward, we want you to issue dividends equal to 15% of net income. We'll start this just for next year. So that would be a payout ratio, right, of 15%. And so that's okay. But now the CFO needs to know a lot of things about this. So her first big question is, well, that's going to definitely give us a hit on our cash account. So my big question, says the CFO, is what's our projected end of year cash balance 1 year from now after we issue the dividend? So what does that mean for us when we're doing pro forma projections? We're going to be solving for the cash account on the balance sheet. She has some other questions. Okay, 15% of net income is one thing, but what's our estimated amount of the dividend? And are our projected cash levels going to be safe? She feels like the company has enough cash on hand for working capital needs if the cash level of the company measured at the end of next year is going to be greater than or equal to 5% of the year's sales. And she also says, I'd like to see a general ratio analysis for the same as what we've done in the past. So let's put together the most recent year and a new year, so we'll have 2 years worth. All right, so now, as usual, we stumble into the company as interns. We're working for the CFO, and she's going to assign us the task of doing all this. So she's got to give us a lot of information to make this work. What is her assumption on sales growth for next year? So she's estimating sales growth of 10% next year. She also tells us, this comes down from the board, that the dividends should be set at 15% of net income. And she says, we want to just leave the debt constant, okay? No more debt. We don't want to incur any more debt. We're not going to pay down any debt. Just leave it constant, okay? And the way she has found that they're growing their PPE properly to match their 10% sales growth is she feels like everything works out well if she targets the PPE at the end of the year to be equal to 100% of the year's sales. So she tells us to model that. And she notes here, which we've already seen, that the average depreciable life of their assets is 10 years. So what that means is the depreciation in any given year is going to be about 10% of beginning of period net PPE. And again, she says that the safe cash level is 5% of TTM sales, and there's going to be no stock issuance or buyback, so no change to paid in capital. And given this info, she tells us, be free, fly, figure this out by lunch, and get back to me. Oh, so now we're really in trouble. Let's see if we can do this by lunchtime. Okay. All right. So we're going to have to project forward the things that we mentioned. First, the PPE roll forward equation. So let's see how we can do that. What we want to do is look at the PPE roll forward equation in the latest year, okay, which I've got right here. And then for each quantity, we want to decide what's our rule source for projecting it forward? And then specifically, how are we going to project this quantity? Okay, so for the PPE net beginning of period, well, that comes right out of the equation. That's always equal to last year's end of period PPE. For depreciation, how are we going to project this? Well, the rule source in this case, remember, first thing we want to look for is, do we have something dictated from the CFO or the board? And we do. And she says that depreciation should be 10% of beginning net PPE. And do we have anything for CapEx? Well, we don't have anything from the CFO that specifically mentions CapEx. So let's leave that for a second. Let's go down to the next one. The PPE at the end of the period, remember she said she's targeting that should be equal to 100% of TTM sales. So we have a directive for that from the CFO. So now what you want to notice here is that we have an equation. Here's our equation, right? And in this equation, we're going to be able to compute 3 of the 4 things in that equation. We know that the beginning of period net PPE is going to equal last year's end of period. We know depreciation is going to be 10% of the beginning of period PPE. And we know that the PPE at the end of the period is targeted to be 100% of sales in the year. So through the awesomeness of algebra, we should be able to solve for the CapEx. So the CapEx is going to be equal to here, our PPE, PPE, BOP, sorry about that, EOP, and that's going to be minus PPE. I'm doing the awesomeness of algebra on this here, the equation up over to the left, minus PPE, BOP, and that's going to be plus depreciation. Okay, so all I did was a little bit of algebra on this equation up here. And let's see if I've got this right. If I've got this right, 18.18 should be 100 minus 90.91 plus, what's our depreciation? 9.09. Okay, and 9.09. Whoops, hang on, fella. There we go. All right, so let's see what we've got here. And let's go up and, as usual, just confirm for you all that this is correct. And there we go, 18.18. So that's looking good. All right, so that's the way it's going to work when we project forward. All right, now we're going to have to project second income statement. So we've got the same idea here. I've got the historical income statement, the most recent income statement here. And then for each item on this income statement, I'm going to say, what's our source for how we're going to project it? And then specifically using that source, how we project it. So what's the source is here, and then specifically using that source, how we're going to project it is here. So for sales, we have a dictate from the CFO. She said, assume 10% sales growth. Okay. And for COGS, so the CFO didn't say anything to us about COGS, and we don't have an equation that I gave us long ago and far away. Remember that one page of equations? That should be on your helper sheet. There was no equation there with COGS. So that means we have to go with percent of sales. Okay. And in this last year, we had sales of 100. and 68 in COGS. So I think that works out to 68% of sales. So that's how we're going to project forward the COGS account. Whatever the sales are in the next year, we're going to say that COGS is 68% of that amount. Okay. All right. So now let's go to the next one. Depreciation, we've already gotten from our PPE roll forward account. So we'll project the PPE roll forward account first. And then from that, we'll be able to get our depreciation value. So that's looking good. All right. SG&A expense here. There was no dictate from the board, not mentioned in one of the equations that I had on that page. Let me jump back to that page of equations just so everyone is reminded about what that is. Here it is, these accounting equations. So no COGS mentioned here. Anything that's not mentioned here, if there's not a directive for us from the board, we have to go with percent of sales. All right, so let's get back here. Okay, so for SDA, not mentioned in one of those equations, nothing mentioned from the CFO, so we got to go with percent of sales. So in 20X0, the most recent year, SDA was 10% of sales. So what we're going to say is in the year we project, whatever the sales are, SDA expense is going to be 10% of that. Okay, and let's just keep working down here. So interest expense, we definitely had an equation for that, right? That's the pre-tax cost of debt capital, right? Our interest rate, which is 7.25%, that was given to us. And so projecting going forward, we're going to take whatever the debt is at the beginning of the year, multiply that by 7.25%, and that's going to be our interest expense. And then finally, for tax, we do have an equation for that. Tax is going to be 33% of EBT, right? So I've computed that for us here. You can check it out for yourself. So EBT is 12.91 minus 1.36, and you can verify that 33% is what we should be using going forward. All right, and now let's get to our equity roll forward. We're doing the same thing. We're just looking at what's going on this year when we project ahead, what's our rule source, and then specifically, how are we going to project forward? Okay, so equity beginning of period, that's always equal to ending equity in the prior period. That's pretty, so let's say project as ending equity prior period. All right, and then net income. Remember, we will have already projected our income statement, so we'll be able to just fill in net income from our income statement. And dividends, for dividends, we do have a dictate from the CFO and the board, no dividends, all right? So we're, oh, I'm sorry. Of course not, no dividends. I'm thinking of no change in debt. Yeah, so we do have a dictate from the board. I take it all back, right? The dictate from the board is they want to start getting dividends equal to 15% of net income. So that's our dictate, and that's what we're going to use. Whatever we find for net income in the next year, 15% of that is going to be the dividend to shareholders. Okay, and then paid in capital, we have a dictate for that. The board says no share issuance, no share buyback, so that's going to be equal to 0. All right, and then our equity at the end of the period, how can we get that? Well, in this equation, we will know everything except for equity at the end of the period. So we'll just solve the equation for this equation for equity end of period. So let's see how that worked for year 0. So for 0, that worked like this. All right, so we wound up with 80, and that was equal to 76.85 plus net income, 7.74, and minus 0, because there were no dividends last year, and then minus, there was a share back, 4.58. Okay, and that's the way that it worked, and that's what got us to 80. Okay, and that's equal to, of course, equity BOP plus net income minus div plus paid in capital. All right. And then finally, the last thing that we're going to project is the balance sheet. Same story with the balance sheet. We're going to look at all the accounts on the balance sheet, where they were in the most recent year. We're going to see what our rule source is. Rule source is always CFO or board directive equation on that page of accounting equations I showed you. And if we have neither of those, then we go by constant percent of sales. All right, so let's start account by account with the balance sheet. So first thing we have is cash. That's our big question item. Okay, so that's the one we're going to solve for, and we're going to use assets equal liabilities plus equity to help us solve for that. All right, accounts receivable, no equation for that, no dictate for that. So that's going to go as percent of sales. Okay, remember sales in the most recent year were 100 million and accounts receivable is 25. So that's how we say going forward, we're going to project as 25% of sales for accounts receivable. Whatever the sales are in the next year, we say accounts receivable are going to have to be about 25% of that. Similar for inventory, no dictate from the board, and we've got nothing in terms of our accounting equation. So that's the situation we have to go with percent of sales. Okay. And PPE, we will already have solved by the time we get to the balance sheet, the PPE roll forward. So we'll just grab the number that we need for PPE net end of year from the PPE roll forward equation. And accounts payable, other current liabilities, no directive from the board, nothing in our page of accounting equation. So we go with percent of sales. And debt, we do have a dictate, right, from the CFO. She says, hold the debt constant. And we get to equity. We know our equity because by the time we get to the balance sheet, we've completed our equity roll forward equation. So we just take the value of equity and plug it in from our equity roll forward equation. Okay. And now, as you can see at this point, we will know every item on the balance sheet except for cash. And then we can use assets equal liabilities plus equity to solve for cash. Assets equal liabilities plus equity, cash plus all other assets equal liabilities plus equity. Through the magic of algebra, cash is equal to liabilities plus equity minus all other assets, and we can solve for cash. And that's what we'll do. All right, so now I think we're ready. We know how we're going to project every account, and we know at the end of the day we're going to have to solve for the cash value on the balance sheet. So I think we're ready to get the show on the road with projecting for future year number one, the next year in the life of this company.